Welcome everybody to the Rainey review for March 2026. This slide shows the growth of $1 invested in various asset classes for the 3 months ended 31 March 2026. This is quite some chart. Going up to the end of February, things were looking quite rosy, only for them to drop away quite precipitously in the last month. I'm going to come back to the reason for that shortly. The leader this quarter is unhedged global infrastructure in orange, where $1 invested 3 months ago would have grown to $1.12. In second place, in Australian gold, is Australian shares, where $1 invested 3 months ago would have grown to almost $1.02. Middle of a now crowded and anemic looking pack is that 50-50 mix of shares and property and cash and fixed interest, where $1 invested 3 months ago would have fallen to 99 cents. That's not a very good start. This slide shows the growth of $1 invested in those same asset classes now for the 12 months ended 31 March 2026. The leader over 12 months is emerging market shares in red, where $1 invested 12 months ago would have grown to $1.28. In second place, again, is Australian shares in Australian gold, where $1 invested 12 months ago would have grown to $1.21. In the middle of that now unambiguously positive pack is that 50-50 mix of shares and property and cash and fixed interest, where $1 invested 12 months ago would have grown to $1.09. That's a pretty good year, despite a pretty ropey quarter. But I always say 1 year is not long enough. We always need to look at least 3 years' data. This slide shows the growth of $1 invested in those same asset classes now for the 3 years ended 31 March 2026. The leader over 3 years in navy is unhedged international shares, where $1 invested 3 years ago would have grown to $1.75. In second place, in red, is emerging markets shares, which would have grown to $1.66. In third place is unhedged global infrastructure, where $1 invested 3 years ago would have grown to $1.60. Standing out in the middle is that 50-50 mix of shares and property and cash and fixed interest, where $1 invested 3 years ago would have grown to $1.27. That's a pretty solid result. I began 2025 by talking about President Trump. Given the state of the world, it is apparent that I need to do so again. President Trump gave the order to proceed with Operation Epic Fury February 27. On the morning of 28 February, the US announced that it and partner forces, Israel, had begun airstrikes against Iran. Iran retaliated with ballistic missile and drone strikes against Israel and surrounding Gulf states. The war has gone through so many phases of escalation, de-escalation and re-escalation that it is natural to feel anxious and uncertain about the world. At the time of filming, the initial phase of peace talks appears to have failed, but Pakistani diplomats have been actively trying to bring Iran back to the negotiating table. Unfortunately, only time will tell when we will have a resolution to the war. All of this, naturally, disrupted oil supply, trade and markets during March. It also created fear and uncertainty. We acknowledge this uncertainty. Fear even is completely natural given the state of the world. We have had it suggested to us that the war must mean that markets will fall. Well, actually, that's a hypothesis. That means we can test it. Does the S&P 500 index, the largest market index in the United States, fall after the start of US military conflicts? Luckily enough for me, the excellent Charlie Bilello of Creative Planning has actually already tested this for me, so I can just lean into his work. This table shows the performance of the S&P 500 index 6 months, 1 year, 3 years, 5 years, 10 years and 20 years after the start of US military conflicts, going all the way back to World War II. The data is quite clear. On average, the S&P 500 index goes up after the start of US military conflicts. Remembering that the S&P 500 index from 1928 to 2025, no, I'm not expecting you to remember, but I do, had an average compound annual return of 10.03%. This data shows that actually the returns after the US starts military conflict are slightly higher than the long-term average. So, does the S&P 500 index fall following the start of US military conflicts? On average, no. Another question we get is, Shouldn't we wait to invest? After all, there's more uncertainty, isn't there? Actually, that's two questions. Shouldn't we wait to invest? And there's more uncertainty, isn't there? Answering the second question first, actually, the answer right now, surprisingly, is no. This graph is of the CBOE, formerly Chicago Board Options Exchange, Volatility or VIX Index. The VIX Index is commonly known as the Fear Index. It measures expected market volatility of the S&P 500 index over the next 30 days. The long-run average of the VIX is between 18 and 22. Anyone else would call that 20, but that's not really how economists think. We can say that the long-run average is 20. Values above 30 indicate elevated fear and uncertainty, whereas values below 20 indicate normal or stable markets. Given the time frame of the war, I've gone back to the beginning of the calendar year. While there have certainly been spikes, even one in late March topping that 30 elevated fear and uncertainty measure, overall the VIX has stayed mostly within that band of 18 to 22 throughout the conflict. The answer to the first question, should we wait to invest, is again probably no. This table, also taken from the excellent Charlie Bilello, shows the 25 largest one-week increases in the VIX index that we discussed on the last slide. There are a couple of things to note about this table. One is that even though the beginning of the war created a large spike in volatility, with the VIX index increasing by 48% in early March, that is actually only the 21st worst spike since the establishment of the VIX index in 1990. The other thing to note about the table is the sea of green. And no, I'm not about to launch into Yellow Submarine for you. I'm probably more of a get back kind of guy. Anyway, the columns to the right show the performance of the S&P 500 index after the spikes in volatility. The green indicates that, mostly, the returns after 4 weeks, 3 months, 1 year, 2 years, 3 years, 4 years and 5 years are positive. In fact, on average, the returns from the S&P 500 index after a spike in volatility, that is, an increase in risk, are higher than the returns during other or normal periods. Actually, that makes a lot of sense. After all, returns are reward for risk. When risk is elevated, investors require more reward, that is, return. So, to both mix up my musical references and to give you the answer to Edwin Starr's question, war, yeah, what is it good for? Absolutely nothing, but it might not be all that disastrous to your wealth. Thank you all for watching. I look forward to updating you again in the next edition of the Rainey Review.